Hi, it's Lee. Welcome to the Tesla Economist. Right, so Q4 earnings report. We have auto revenue all the way up to $21 billion and a massive $5.5 billion in auto gross profit, hitting a 25.9% gross margin. However, some of this was attributed to a massive regulatory credit payment of $467 million. If we remove that, then gross margin was 24.3%, compared to 26.8% from Q3, a 2.5% drop in auto gross margin. We were also given the FSD revenue of $324 million. If we remove the FSD revenue from the gross profit, then we are at a margin of just 23.1%. Tesla were only offering the discount incentives for part of December, so it looks like cost of goods sold have potentially risen too, and margins are not quite as high as I thought. And these are, of course, lower margins on lower ASPs. This does, however, factor in some price drops in China. What's going to be far more interesting is the margins that we'll see next quarter that will factor in all the lowered prices. Q1 is going to be a far more telling quarter as to the trajectory of Tesla for the year since these price drops. For comparison, Tesla were at nearly 30% margins, excluding credits, between Q3 2021 and Q1 2022, until the new factories came online. However, as Tesla ramp up more vehicles, the OPEX per vehicle does reduce through economies of scale. Operating margin is more important anyway, and Tesla still achieved 16% margin. Again, it will be interesting to see what Q1 looks like. The cost of goods sold per vehicle appears to be down slightly from last quarter, by about $300. However, a lot of the ramping was due to the lower cost Shanghai models, which do cost less to build. But I don't think the costs have been rising from inflation, at least not quarter over quarter. We're told that Austin produced over 3,000 vehicles in a week at the end of Q1. I believe we've already been told that they're actually at 3,500, and we're told the same number for Berlin, over 3,000 vehicles a week. These are still not great rates for such large, expensive factories. However, now the prices have been dropped so much, I think these factories will no longer be breaking even, or if they are, the margins will be very low. I would say that most likely Texas will have negative margins. I also don't think they have the cell capacity to ramp these factories up much more. In fact, this is potentially evident in the guidance we were given of 1.8 million vehicles sales for 2023. Now, Tesla was at a run rate of close to 2 million in Q4, if we factor in the downtime in Shanghai. And admittedly, Elon does say Tesla could produce 2 million this year as long as there are no unforeseen events, and has enough demand to sell all 2 million. But let that sink in. Tesla are already at a run rate of at least 1.8 million, so where's the growth in production for the whole year? Do you see what I mean? We have about 1 million a year from Shanghai, 600,000 from Fremont, then at 3,000 a week from Texas and Berlin is another 300,000. That takes the total to 1.9 million units, implying no vehicle production growth, which would also imply no ramping of the new factories, which could also imply no 4680 ramping. Yes, even 1.8 million is still some good growth year over year, but quarter over quarter compared to Q4 production, well, it's flat. This is quite concerning, especially if the new factories are now only about break even. They'll bring down margins. Remember, part of the reason numbers were lower last year was that we had quite a bit of downtime. So it's not so much that deliveries will be up this year, more that we were down last year. But that's not entirely fair, as Tesla seriously ramped up Shanghai in the last quarter, and the new factories are at a rate of over 300,000 a year now. I need to do some numbers on this. We should be able to get a good idea of what margins might be now. Along with 1.8 million deliveries, we should be able to get a good idea of what earnings will be for the year. What I was most interested to look at in this report was energy. As I'm sure you all know, energy has been in large discussion lately, as we have the new Megapack factory ramping up. There were even rumours that Tesla were at 35 gigawatt hours a year run rate already, which did seem hard to believe. But we can see that the storage deployed is now at 2.5 gigawatt hours a quarter, up about 1.5 gigawatt hours a quarter from where we usually are. Now, I'm not saying that 1.5 gigawatt hours is what the new factory is producing, as some of the previous was also the old Megapacks. They were using the 2170s. So I would guess that perhaps we are at 2 gigawatt hours a quarter run rate at the Lathrop factory, or 8 gigawatt hours a year, which is a 20% capacity already. Elon says that energy will ramp faster than vehicles, which we should expect. Margin for energy is up to 12% now, from 9% last quarter, so the new factory is clearly making more profitable Megapacks. And as it ramps, we should expect those margins to increase as well. It's rumoured the profits could be as high as around 50% margin, which would be insane when they hit 40 gigawatt hours a year capacity. We're talking an additional $10 billion a year in gross profit, which might not be far off what autos will do this year. And will be recession resistant too, so energy could really bolster the profits, or even carry the company if the recession was severe. This is definitely a part of the business to keep an eye on, and the numbers check out that they should have a spare 40 gigawatt hours a year of cell supply from CATL for this factory. Although CATL will also be getting into energy storage as well. I'm wondering how much more supply CATL will actually be willing to offer Tesla, as CATL are vertically integrating with EVs as well as storage, and they also have the most energy-dense LFP cell in production, with their M3P cell, which contains a hybrid cathode system with LFP and ternary cathode. The Chilim battery is also structural. In other words, they might have longer range than Tesla's Model 3. On the other hand, volume production is hard. I need to run some numbers to see what 2023 will look like as far as earnings goes. I think we can get a fairly accurate idea now if we use 1.8 million as a guidance. I know Elon says that margins won't be below 20%, but I'm not entirely sure, unless he's including regulatory credits. But even if he is, we have some serious price drops, and all those price drops come out of gross profit. I think Model Y in the US is at its market clearing price now. In fact, Tesla even raised the price slightly, but it doesn't allow many options for customers who want to be eligible for the tax credit still. And obviously, Tesla can't raise the price above the limit for the credits. Inventory for the Model 3 in the US is starting to build up again, so I'm going to guess there will be another price cut there. On top of that, in March, we may discover the Model 3 is only eligible for half the tax credit, $3,750, as the LFP batteries they use are imported from China. So Model 3 could potentially drop a further $5,000 or so in price, perhaps to around $38,000 excluding credits, which is about the price it was in early 2021. However, I have this car still at a 33% margin, so they do have a bit of a buffer there, as they didn't need to knock down the price in order to qualify for the tax credit. All in all, I've got to say that this was kind of disappointing. I know it's going to be a tough year with interest rates being so high and Tesla's costing 10% more as a result, and all other cars for that matter too, of course. But there's no production growth outlined here. If anything, a slight cutback, with the reason being that there could be all sorts of events that affect production. A lot of people thought Tesla lowered their prices for a price war in order to gain market share, except there are two elements to that. One is the price reduction, the other is the supply expansion. Tesla appear to only be doing half of that. Of course, if they did want to expand supply more, then it would also result in a further price reduction again, and margins taking a bigger hit. I know a lot of you get tired of me saying this, but I really want to see 4680s ramping. My valuation of this company was all about the production growth that is limited by cell supply, and in addition to that, reducing the cost of the vehicles with the 4680 cells in order to increase demand. I've never valued the future on FSD as it's not something I can personally quantify, and I refer to it as a lottery ticket. Yes, energy can be good too, but it still appears to be moving slowly. I thought that perhaps the Megapack factory would ramp up faster, as it is presumably a more simple product to assemble than, say, a Model Y. Anyway, like I said, Q1 will be much more telling of how 2023 will go when we see the new price margins at the lowered price points. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.